I'll point out that nobody more than a central banker wants you to think that QE is not money printing. So of course, the central banks are going to say it's not money printing. And when I hear the asset swap thing, one thing I point out is that it is an asset swap. We have to ask what happens before the asset swap. Did they have an asset that then they swap for something, or did they create an asset that they then swap for something? And so it's not that it's not an asset swap. It is. It's that they create a reserve and then they swap it for something.
Quantitative easing, or QE, happens when central banks, like the U.S. Federal Reserve, print additional money to purchase securities like bonds or other types of debt. Some worry that it is simply printing money and will lead to hyperinflation or extreme inflation. Others argue that it has no effect on inflation because newly created or printed money is locked away in bank reserves, rather than ever reaching Main Street, a term for the general population, or that the printed money is otherwise offset by deflationary forces of debt and demographics. However, based on history and math, the inflationary side of the argument is ultimately correct, though with many nuances along the way. To a long-term debt cycle refers to a multi-decade peak in governmental and private indebtedness, proportional to the size of the economy and money supply. According to Lyn Alden, we are currently coming down from this peak and are in the drawn-out resolution phase of this cycle. Immediately after interest rates reach zero, this happens. The last time we went through this resolution process was during the 1920s and 1930s, when we reached the previous apex of a long-term debt cycle. This resolution process has now been ongoing for the past 12 years. The main point of this video is that there are two very distinct conditions to take into account when analyzing the possibilities between inflation and deflation and what constitutes money printing, quantitative easing on its own, and quantitative easing combined with enormous fiscal deficits. As Lyn Alden discusses quantitative easing, money creation, the dollar shortage, and treasury market levels in the video, let's get started. Remember to like, subscribe, and leave your comments below while you watch.
QE is basically when the central bank creates more bank reserves and then swaps them for some sort of asset, usually a government bond or mortgage-backed security, or in rarer cases, it could be other assets like the Bank of Japan will do it with equities. But normally the most common one would be government bonds. The government is in a position where they're selling bonds and they're not pulling capital out of the market. They're not, if I have dollars and they sell bonds to me and I give them dollars, they're pulling dollars out of the economy and they're putting treasuries into the economy. And from my perspective, I don't really care if I'm just using them as savings. And maybe they do it for foreign sector, maybe they do it for other sector, but if they run out of buyers or if they want to jack up asset prices, they say, okay, we're going to sell bonds into the economy, which allows us to spend money into the economy. But instead of pulling that out, we're not pulling dollars out of anybody. There's no real buyer that's buying these bonds. It's that the central bank is creating bank reserves and then buying the bonds. The caveat where the money printing question becomes relevant is that if you're just doing QE without super large deficits, or if there's loan destruction, like defaults that are happening that are bigger than the deficits, then it won't be inflationary because you're not just sending money to people. The biggest kind of combo that really becomes money printing is when you have very, very large fiscal deficits, especially ones that are direct to, not the top 1%. If you're actually sending people PPP loans to turn into grants, if you're sending them stimulus checks, and then you're financing that by QE, by QEs to finance that fiscal spending. During COVID, there was a huge spike in bank deposits. So not just bank reserves, but bank deposits. And so, there are people, for example, you're working as a school teacher, you had $10,000 in the bank, the government sends you money, it shows up in the bank. Now, if that was not financed by QE, it'd be coming out of other bank reserves somewhere. It would come out of bank deposits and bank reserves. But because they were able to inject that without pulling it out of anywhere else, they actually increased the amount of broad money in the system. And in that example, it was not from bank lending. Banks were not doing excessive amount of lending during COVID. Instead, it was the fiscal stimulus going around the fact that the banks weren't lending. And so if you go back to, say, the 70s and 80s and things like that, that inflation was not because of QE. It was not because of large fiscal deficits, although they weren't helping. The fiscal deficits weren't helping. It was primarily because of demographics and bank lending in the 70s. That's where most money creation was coming from. Whereas the biggest ever spikes in broad money supply, so let's call it bank deposits plus currency in circulation. The biggest spikes ever in those were the 40s and the early 2020s, and that was when things seized up, banks weren't lending, and there was very, very large fiscal deficits that were then monetized by the central bank. So it's especially that fiscal plus QE combo. And you can imagine, in March 2020, the treasury market completely froze. Bid-ask spreads blew out, liquidity blew up. The foreign sector has tens of trillions of dollars of assets. They were starting to sell hundreds of billions of them for dollars because they had a dollar shortage, which you cover all the time, all the Eurodollar stuff. They're selling assets to get dollars, and the whole thing seized up. And so if you have a completely liquid treasury market, and the treasury says, bad news, we're about to issue trillions more treasuries into a liquid treasury market that foreigners are actively selling, that's where the Federal Reserve comes in and says, well, we have a solution. We're going to create more base money and swap them for those treasuries so that you're able to finance that even though there's nobody in the real world who's actually swapping dollars to get these treasuries. You're unseizing a illiquid market because of that. One thing to think is that every security in the market is basically a claim for dollars, right? So we have tens of trillions of dollars locked in the equity market, tens of trillions of dollars in real estate, tens of trillions of dollars in bonds. And technically, any owners of those securities can sell those with the expectation that they can get dollars in return. But of course, the problem is that you have literally over $100 trillion worth of these assets and nowhere near as many actual dollars, especially base dollars, let alone broad claims on dollars, to actually satisfy those. So at any time when you have a higher than normal amount of net selling for these types of assets, you get a liquidity problem. And we don't just see this in the U.S. So, for example, going back to say let's start with the U.S. for a second. So, for example, during the COVID crash, and then actually again during the gilt crisis in like September, that kind. So, if you look at before we get to the U.K., if you look at the U.S. market, both those times in March 2020 and in September 2022, the Treasury market was getting really illiquid and wobbly, and in March 2020, it was the off-the-run securities that had the biggest issue. But if you also look at treasury auctions, so brand new treasuries coming to market, you were getting like fat tails on these auctions. And so a sign of a successful auction is that, when you're bidding the treasuries out, the first price and the last price shouldn't be very different, right? Because it's kind of like there's far more buyers than you're selling, and the first security you sell, the last security you sell are basically the same price. When you have like a sloppy auction, there's like not enough buyers kind of, and it's just like really shaky, there's bad liquidity, you get a long tail where like the final security sells for a much worse price than the initial security. And you saw that both in March 2020, and then you saw it again in September 2022. But then of course the worst example was what happened in the UK, where they come out, there's high inflation, they're about to pivot and start doing QT. And then they come out and say, hey, we have this new budget, bigger deficits. We're going to issue a ton more gilts, UK sovereign bonds. The market throws an absolute fit. Yields spike. But then, of course, the problem is that all these pools of capital hold these assets on leverage, all these pension funds. So they have to start selling. And then it goes back to the thing. There's so many holders of sovereign bonds, and all of those are claims for dollars. And so if you get tons of sellers, in this case, pounds, you have all these claims for pounds at the same time, and it just would completely liquefy itself, and there's just not enough pounds to meet that demand. So what happens? The Bank of England had to literally cancel a speech. They were going to talk about balance sheet reduction. They had to cancel a speech the next day and be like, just kidding, even though there's 10% inflation, we're going to go ahead and create new bank reserves to buy these gilts because too many of them are selling at the same time. And so it's a reliquefaction. It's basically a buyer of last resort, not with existing dollars, but pounds, but with brand new pounds that are just created out of thin air to take those off the market for the fact that there's no actual genuine buyers of them at these prices.
Following the bank failures this spring, problematic customers have already significantly switched to money market funds that invest in corporate and sovereign debt. By raising investors' expectations that more rate rises are on the way and potentially decreasing demand for government debt. At present rates, last week's blockbuster headline employment data may have increased pressure. Which rate increase do you anticipate would occur next? Post your predictions in the comments section below. We sincerely hope you enjoyed the video. Please like, subscribe, and enable alerts for new videos. Thank you for watching.